Alright, we're on episode 5 of how to trade the stock market. Today we're going to be talking about liquidity. What is liquidity? Liquidity is probably going to be the most important thing that you learn in the market. So you're going to identify liquidity. You can start looking for an area of consolidation, like something. It's going to kind of look like this. Section this off right here. So you see how this area is very smooth, or even something like this. You want to look for very smooth areas, spots of consolidation. Something like that where, candles are just kind of bunched in real tight together. And you can find one any time frame. For the purpose of the video, we're just going to stay on the hourly. So you have some liquidity there. So you have liquidity in these smooth areas, and liquidities are also going to be resting above highs, swing highs, swing lows, and the reason why liquidity is important, because without it there would be no market. Now think of liquidity as, like I said, you have smooth areas like this. This section right in here. And you also have liquidity above old highs, swing highs. So you have liquidity here. You have liquidity above this high. You have liquidity above that. And you also have liquidity above these lows. Above these lows and these lows. Like this. So you have liquidity in consolidation areas. You have liquidity above highs. You have liquidity above or below lows. And you also have liquidity when you have like an equal low. So see these two candles right here? See how they're about equal? That's what you're gonna call equal lows. You're gonna have liquidity above that right here. You would call these equal highs because all these highs are about equal. So right here, let me section that off. So I'm going to bring your attention to these equal highs right here. You're going to have a pool of liquidity right above that. And you're going to have a pool of liquidity right below this. Equal lows, equal highs, swing high, swing high, swing low, swing high. And the market moves to these areas. Like I said in the first video, people buying and people selling is not the reason the market moves. The market moves to liquidity. Now there's people that profit from the market going down and people that profit from the market going up. And they have stop losses. Now a stop loss is going to be an area where people put a stop order. For example, let me bring up this tool. So think of this red area as if price went below this, they would want to get out of the position. So if someone entered, say on this candle, and they're looking for it to move up, so their profit is up here, they enter the position down here, they're going to put a stop below this so that if price goes below this, they're going to want to get out of that trade so something like that doesn't happen. So a stop loss is exactly how it sounds. It stops your losses from becoming too big. So there's going to be stop losses below, swing lows. There's going to be stop losses above, swing highs, equal lows. Now look at this consolidation area. There's going to be stop losses above that. Look how price moves just above it and then move lower. Now we're going to get into that at a later date, but just a little bit of foreshadowing. Just look at that. Right now, the only thing you need to worry about is we're going to take this series very slow. The only thing you need to worry about in this video is you know what your swing lows are. So you're going to have liquidity below that. You're going to have liquidity above swing highs, and equal lows. Now real quick, let me go to a random day. I'll section it off. Now within this area right here, look for the areas of liquidity. Now we're going to go deeper into it later on, but just for this video, I'm just gonna touch on it a little bit. I'll pause your video and find some areas of liquidity. Just look for 3 of them. Alright, hopefully you paused your video. Now, the main thing that should have stuck out to you is these equal highs right here. Look at all these highs. Look at all these equal highs. Look, pool of liquidity right here. And then below this low, below this swing low, there's some more liquidity there. And the market moves to these levels. So we came down, took out the liquidity. Notice how up here, these equal highs stayed intact. I'll mark that on red just for now. So, liquidity below this low. And then there's liquidity below these lows right here. The market came down, took out that liquidity. So the market is going to be moving in objectives. And one of those objectives is going to be to take out liquidity. Because there are going to be people placing their orders, their stop loss orders below these levels. And the market is going to try to take it. It's going to try to take those orders. But notice how this level is left up here. Watch what happens. We'll scroll over. and that's not yet been taken. So at a later date, this liquidity will be taken. Now just for reference, take a look right here. Take a look at how we have many equal highs right here. So we have equal highs, equal highs. They haven't been taken yet. Days later, we come down, take out the liquidity down here. Look how price just dips below this low, just barely. And then it comes up, takes out that liquidity, comes down, takes out these lows, and then back above the highs. Now, I don't want to go too deep into these videos, but that's your homework. Look for areas of liquidity. I'll identify a little bit more. You have right above this high, there's liquidity. Below this low. Now, of course, you're going to have liquidity below things like this low, this low, and this low, but you want to look for the areas that stand out, the obvious levels. So, many equal highs, very obvious swing low, very obvious swing high, and of course, they're going to be below these. But look, obvious, very obvious level here, 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 and up here. But yeah, that's your homework.